Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me are Surbhi Upadhyay and Pavitra Parekh. The screen is still green, but the gains are petering off and fading off as we speak. So currently just up close to about 0.1% on the benchmark indices. And the screen is a big contrast to what's happening globally, where Nikkei is up close to about 2%. Hang Seng has a gain of nearly 1.5%. There is more than a 1 percentage point gain on the other Asian markets like the Singaporean markets, Taiwanese markets. So our gains are really very modest compared to the kind of buoyancy that we're seeing in our neighborhood. If you are looking for some thematic sectoral movers, it's metals, which is drawing strength from the pullback that we've seen in dollar. So the metal index is up about 0.5%, but again, it slipped from the top of the trading session. In the morning, the metal index was up more than 1%, with names like Tata Steel, Hindalco leading the rally. Autos are doing well. The Nifty Auto Index has a gain of close to about 0.7%, but topping the charts right now sectorally is the PSU Banking Index, and that's up more than 1%. So pull up the Nifty PSU Banking Index. Again, slide from the kind of highs that it had put in at about 10.15. But really, the big event, and that's going to be dominating, is going to be one of the most complicated, high-stakes FOMC Fed meeting. And pause, pivot, hike. 2 weeks back, we were talking about, well, are they going to do a 50 basis points?
Rate hike.
And, yeah, 50 basis points of a rate hike. And now we're, debating that, is there a case for them to pause, right?
Oh, absolutely. Well, I'll tell you what, the Fed futures point towards a case for a 25 basis points rate hike. And actually, markets around the world, not just equities, asset classes around the world are positioned for a 25 basis points rate hike with a lot of dovish commentary, with the Fed basically saying, don't worry, we are there. Absolutely no reason to get jittery over the banking issues or not. And the good thing is that as we get into the Fed meeting, at least globally markets have stabilized, volatility levels have come down, and we saw that big pickup on Wall Street overnight as well. However, the fact that Reema pointed out is a concerning one, because you have a roaring rally across a lot of Asian markets. Hong Kong, for instance, still up about 2%, as is Japan. But the Indian market is completely cooled off from the morning highs. And that's happening because of the bank Nifty all over again. The banks are playing spoil sport. A lot of other parts of the market that are working well, insurance, for instance, some of the auto names, IT. Banks are where the problem is. Pull up the bank Nifty, the intraday as well as the contribution, and you'll see that in sort of stocks play out as well. That index is virtually at the flat line right now, and some of the names like Axis Bank already negative. So we need to watch this. So much selling happening. One, of course, viewpoint could be that there's a lot of redemption that mutual funds are facing, and that's what Naren told us in the morning, that banks don't have an option, mutual funds don't have an option. If they have redemptions coming in, they're so heavily loaded on bank stocks that invariably you end up selling banks, and that could explain the kind of pressure that we have seen consistently, at least on the private sector names. But I think, Pavitra, at least the PSU lot, they're slightly better off than the big private sector ones.
It's so split, right? Like Reema was pointing out, the PSU bank index is the top gaining index, but the private banks are right at the bottom. So take a look at Axis, HDFC. These are the ones which are seeing sharp cuts, even as the PSU bank index holds up well. Reema was also mentioning the large cap metal names. Take a look at how some of the mid caps are also faring, because there is, moves over there as well. So something like an NMDC, Hindustan Zinc, Hindustan Copper, these ones will come up for you. And you can see that there is a significant move that we're seeing on the upside there as well. So this pack holding quite steady. Something like a steel strips, by the way, is up 7%. So we'll talk about that as well. On the downside today, you're seeing a lot of the PSU stocks. So you have, ONGC, NTPC, BPCL, these ones seeing some cuts. So this is something that we will track, and that's what's really going on in terms of market action. But, something that we talk about is that the underperformance in the market has actually turned some brokerages constructive on India. Nimesh is here to tell us more about that. Nimesh, this is something we've been asking all our market guests as well, right? That the fact that there has been this correction, valuations have come down, does it now provide a good buying opportunity? Looks like some brokerages do think so.
It looks like some of them are betting for, being a little constructive on the markets and looking to time this market and buy some of the stocks. So that's broadly the consensus view which is coming in. I looked at two reports today morning. Both were on the similar lines. Both CLSA and Citi has put out a note. And let us start with CLSA first. So CLSA believes it's a contra buy time. They believe that the sentiment is extremely bearish right now, and hence they are advising clients to add beta to their India portfolio ahead of the Fed. Now, they have a proprietary, bull bear index, and that suggests that it's hit a high, almost a bearish level of 91% ahead of the Fed meet. Now, historically, barring few declines in 2008 and 2020, there has been such instances of 10 times when there is such bearishness in the market. And 9 out of 10 times it has been proven that it's a good entry point to enter into this market. So that's what the broad point of CLSA points out too. And adding to that, bullish view, as I said, they've been advising clients to add beta. They're recommending clients to add Reliance Industries, Hindalco, and IndusInd Bank, and they've added these three stocks into the model portfolio, and they've replaced that with Infosys and NTPC. If you look at all the three names, Reliance, Hindalco, and IndusInd Bank, they've been big underperformers, down 15-20% Y2D. So that's where now they believe that there is a time to add. On similar lines, even Citi has put out a note today morning. They feel that the risk reward is much better now, and the reason is very simple. Nifty is down, Y2D is 7%, 6%, and the MSCI India index has underperformed both EM and DM by 8% and 11% respectively. So they believe the risk reward is looking better now. Now, even in terms of valuations, India's valuation is now near the one standard below a 5-year mean. And historically, these are the levels from where markets tend to bottom out and outperform. So that's been the key reason why they believe. In fact, even their sentiment index is suggesting for the first time since July 22 that there could be mid-teens positive returns. So that's been a big case for Citi as well. Well, they've lowered the multiples by half a notch to 17.5%, but and they have a target price of 18,500 on the Nifty for March 24. Even they've made some changes, and they've added Indigo, which is Interglobe, and GAIL to their preferred list. So the bottom line here is, given the current market sentiment, given so much of pessimism which is there in the market, it is time to do some bottom fishing and look to buy into this weakness and not sell out at these levels.
Okay, got that, Nimesh. Thanks very much. Very interesting views from those two, big brokerages that have put out their call. In fact, sentiments that was sort of echoed in a conversation that we earlier had with S. Naren, ED and CIO at ICICI Prudential AMC. Naren says that we may see a good relief rally after the Fed policy decision tonight. He also talks about a lot of his preferred sectoral bets and says that 2023 will probably be a year when you want to sit down and really create your portfolio to reap the benefits in 2025 onwards.
See, at 17,000 valuations are much more reasonable, and the global macro people are just too short on everything, and we have a Fed meeting today, and it is possible that there can be a good relief rally. If all the shorts in the system have to be taken out, there can be a very good relief rally. Does it mean that you can have very big returns in equity from here? The answer is no at this point of time. But is the market tactically well poised at this point of time? Certainly, because the global funds have just turned too negative at this point of time without reason, because they had to go short somewhere and they found India a good place to go short. So I think tactically we are very well positioned. But at the same time, we don't believe in very big market rallies.
With respect to the market here in India, I guess the good thing for investors is that now valuations have cooled off. We're no longer trading 1-2 standard deviations above our mean as we usually do. So in that context, which part of the market looks most attractive to you, where perhaps you would be happy to deploy fresh money as well?
There are areas like banks, for example, which are much more reasonably valued at this point of time. The problem with banks at this point of time is every one of the domestic funds and every one of the global funds has roughly 25-30% in banks. So if there is a redemption, people have to sell 25 to 30% banks. So till you see good inflows, banks don't perform, not because it is attractive and unattractive, but because it is a big holding in every fund. So I would say banking is certainly something which is attractive. Certainly if you look at it, auto is attractive because of all the consumer discretionary stocks, this is one of the sectors where in the last 10 years there has been very low growth. So people don't put implied growth assumptions which are ridiculously high. For the last 6 years, two-wheeler industry hasn't grown or passenger vehicle industry hasn't grown. People don't put implied assumptions which are very, very high. So that makes the industry much more reasonably valued compared to many of the other consumer discretionary industries. Clearly, telecom is a sector where there is still scope for over a next 2 to 3 year period for ARPUs to grow from here. So these are some of the sectors where there is upside potential. The way technology has been tanking, clearly that is another sector where there is scope for re-rating over a longer term period. Pharma as a sector has done extremely badly, and again it is a sector where there is scope for returns over the medium term. So there are multiple sectors where, as you can see, over the last 18 months to 24 months, valuations have corrected. And, if we get many new age stocks also very, very cheap in some of the NFOs, IPOs, if they were to happen, even they can be considered, because they are no one is talking about illogical valuations. So if they come at very low valuations, even we look at some of the new age companies also.
The PSU banking theme worked out very, very well last year. And I think you were in the camp that was quite positive on that space. Do you believe it still offers value? And on the telecom space, the ARPUs are likely to move up, and you've been positive on that space as well. What kind of hikes are you factoring in for this year?
Everything that we decide, like for example, if you take telecom, it's not something that the ARPUs need to go up this year. It will go up over the next 2 to 3 years. Will it go up in the next 6 months? We don't know. It may go up, but will it go up in the next 2 to 3 years? Certainly.
Okay.
I mean, when can you can't actually exactly time. This is exactly like PSUs 2 years back. In 2020 October, most people said PSUs will never deliver return. Could we have predicted when PSUs will deliver return? It is something like that. You can't predict when the ARPUs will go up. Aren't Indian ARPUs very low compared to the world? The answer is yes. Will they go up? They will go up. Can we predict the timing? Answer is no. So that's as far as telecom is concerned. Banks have seen a first round rally, and they are no longer as cheap as what they were. I think next, if there are no big credit events over the next 2 years, they can re-rate. But no longer are some of the banks as cheap, PSU banks as cheap as they were. They have corrected in the last 3 months, so that gives you scope for some near-term rallies. But for the banks to perform, we should not have credit events, and that is the challenge actually in PSU banks at this point of time.
This was a great conversation, and through the day you will hear Naren on the channel. By the way, talking about banks, names like HDFC Limited and HDFC Bank have now slipped into the red. HDFC Limited down 0.3%, HDFC Bank at the low point with a cut of about 2/3 of a percentage point. The Nifty Bank itself is now blinking red. Get into a break. On the other side, we'll discuss what's buzzing in the commodity space. Manisha Gupta joins us next.
Welcome back. You're still tuned into Trading Hour. Only 14 points higher on the Nifty right now. So we've given up pretty much all of the gains since the morning, just slightly off the day's low right now. And this is in sharp contrast to, like we were pointing out, what's going on in the rest of the Asian market. So let's get Mitesh Thakkar in for a quick check on the markets. Mitesh, we have seen a big slide come through, largely on account of what's going on with some of these banks, right? Ahead of this big queue that we are working with, the Fed decision comes out. Would you take a trade on the index level ahead of that very important queue?
So, my sense is that I think, the market was showing some kind of positive traction. We had taken a long trade, which has got stopped out. But the intraday charts are still positive. So, despite the fact that there's an event coming up, I think if we don't start trading below 17,060, we'll maintain some kind of a positive bias, though we may not be aggressive given the fact that the Fed event is always an important, a short-term trigger for the markets. But I think the overall bias is on the positive side. So that becomes a stop loss for long positions. I'm still believing that good chance that we'll head towards the 17, 260, 280, 300 zones. And that remains the target on the upside.
Mitesh, you won't close out your positions ahead of the big event?
No, we haven't done that. In fact, we haven't closed any positions for the time being. And, while the stop loss on the index was hit, and we did reduce our long exposure. But I think we've just adjusted the stop loss on the balance position to about 17,060 and maintaining some kind of long bias. And on the stock side also, with on a trading basis, we have long exposure. So I think still trading with long bias. Of course, I think knowing that you're going into an event, it's not a very heavy, it's not a very aggressive position, but I think the bias is on the upside clearly. Got that.
And what about individual stocks?
Yeah. On the stock side, I think Bandhan Bank is something which is reversing nicely from lower levels. So keep a stop at 206.5, look for targets of 220 here. And IDFC Limited is something which has done very well, still showing good traction on the upside. That's a buy with a stop below levels of 79.5 and a target of around 85.
Thank you very much for that. I want to talk a bit about Sonata Software. Now, Sonata Software is an IT services company, and they won a very large contract. In fact, its largest ever order win at $160 million. The deal is from a US-based consumer retail company for a period of 10 years, and it will be to manage their end-to-end IT modernization and bring in transformation for their customers. So the largest ever contract win of $160 million spread over 4 years, and according to analysts, for their IT services business, because Sonata gets part of its business from the products, wholesaling, distribution of product, but for the IT services business, this could add annually close to about 5% of its revenue. So fairly significant. And remember, just recently, last month, in the month of February, the company had closed out an acquisition of Quant System, which finally got concluded on the 16th of March. So the Q4 quarter, that's the March quarter, will also get about a 15-day benefit from the revenues of this Quant Systems acquisition. And then, of course, Q1 will see this deal ramp up and the full benefit of the acquisition that they've done. So the tide is turning for Sonata Software. These are two significant announcements that the company has made. And today's, of course, is a big one because, generally we've been talking about how, given the caution in the global economy, the deal pipeline could start drying up. The companies clients may turn cautious and not dole out large deals. But for Sonata, they have won a fairly significant one. So that's the stock that we wanted to highlight. Another one that's on our radar is Emami, and that's firing up in trade. Mangalam is here to tell us why. Mangalam.
Well, Emami is higher in today's trading session because the board has announced that they will meet on March 24th to consider a buyback. And this comes after the stock has corrected about 30% from its 52-week high as well. The last couple of results, understandably on account of weak demand situation, hasn't been good as well. Just doing some math, the latest reported numbers that we have of the company, their shareholders' equity is close to around 2,330 odd crores. 10% of that, which is the maximum buyback that a company can do via board's approval, could be close to around 233 crores. And if they go ahead and do a bigger chunk, up to almost 25% is what they can with shareholders' approval. 233 crores and 583 crores is what the company can do, depending on whether it chooses the board approval or the 583 crore mark for the shareholders' approval. However, the cash and equivalents on their books, along with current investments, is close to 250 crores. So my sense is that they would go with the board approval itself of 233 odd crores.
All right, Mangalam, thanks a lot for getting us all of those details. The stock is down 30% from its 52-week high, like Mangalam was pointing out, but today it's surging in trade up 6%. The other stock that we're looking at today is Hindustan Zinc. This one is higher as the board has approved the fourth interim dividend of 26 rupees a piece. So Nigel is here with the details. Nigel?
Well, just not long ago, the street is a little bit nervous whether or not Vedanta Resources will be able to honor its, debt obligations. And it seems that the action that came about yesterday is to fulfill that debt obligation itself, because Hindustan Zinc has gone ahead and declared a dividend of around 26 rupees per share. Now, as you said, that's the fourth dividend that we've received from Hindustan Zinc in this year itself. So it takes the total quantum for FY23 to around 75 rupees and 50 paise. Now, this 26 rupees, the total outgo from Hindustan Zinc will be close to around 10,900 crores approximately. And that would mean all the cash that Hindustan Zinc had as of December 2022, well, all of that will be paid out. Who gets the largest chunk? Obviously, the largest shareholder, which in this case is the promoter entity Vedanta Limited. They have roughly around 65% stake in the company, so they get roughly around 7,130 crores odd. Now, this is good news for Hindustan Zinc, but better news for Vedanta Limited shareholders. I'll tell you why. Because in all probability, the street factors in whatever dividend they receive, they will pass it through. So if that is the case, then Vedanta Limited will declare a dividend of close to 19 rupees. Bulk of that again will go to Vedanta Resources. That's the promoter entity of Vedanta Limited. So they fulfill their debt obligations. The government of India as well gets the second largest chunk from this Hindustan Zinc dividend. They'll get roughly around 3,250 crores rupees odd. So a big dividend was expected, and that's precisely what's happened from Hindustan Zinc. Back to you.
Okay, Nigel, thanks very much for that. So those are some of the stocks in focus. We will take a very quick break on that note. On the other side, discuss the way forward for the market with the Sampath Reddy of Bajaj Allianz. Welcome back to the markets. Tracking small gains. The good news is that we've at least not collapsed into negative territory. Bank Nifty is still pretty much the joker in the pack, and it's at the flat line. There you see some sign of buying at lower levels, but it is a choppy market in a very narrow range right now. So what to make of it and how to sort of navigate these choppy waters? Sampath Reddy, the CIO at Bajaj Allianz Life Insurance, is with us now. Thanks so much, Sampath, for joining in. Good to have you on the show. So it's been a pretty turbulent couple of weeks for the market here. What sense do you make of things? And till we wait for the global headlines to settle, what parts of the market would you look at when one is to deploy fresh money?
Right. If you look at the the current correction in the market, it is largely driven by the global development, especially some of the banks where we had seen severe real mismatch, and because of which the Fed had to intervene and help to solve the situation. If you see that whereas in the Indian market as such, when the interest rates moved up in the last 1 year or one and a half years, the mark-to-market impact on the most of the bonds which are there in the Indian market, let's say, is not really that high. So whereas if you see, global markets, especially the US and all, the interest rates were very low for the substantially long period of time, and when the interest rate moved up, 300, 400 basis points, the mark-to-market impact on some of these banks or NBFCs or lenders has been very, very high. But if you look at the same thing for India, broadly, if you see the outstanding, the government bonds of, let's say, 87 trillion rupees, largely issued mostly around the current, the interest rates, or, we want to take about 100 bits here and there. So the mark-to-market impact on the, the interest rate rise in the Indian financials has been, very, very small, I would say, the negligible. In that sense, our banking system is at a very, in a very strong pace. And not only that, if you see the Indian financials and lenders, the capital adequacy is at one of the best in terms of last, several years, if you take it, versus a required capital adequacy of 9.5. Most of the banks are sitting around 14-15% kind of a capital adequacy. And also the asset quality, if you see that, most of the banks are also sitting in one of the best asset quality in terms of NPAs. So, the recent correction in the market, especially in the banking sector, in the wake of the global financial institutions' failures, I think is not warranted. That's how I would see that. But having said that, as the interest rates have been moving up since last 1.5 years, and because of the very high inflation levels, I think the market, the correction was somewhat anticipated, and the valuations were, slightly, premium to the most of the, the global emerging markets. And because of that, we have been somewhat cautious in the market. I think, we could see, maybe next couple of months more, we could see the subdued market trend will continue. But post that, at least towards the second half of 2023, we believe that interest rates will be, be coming down, and that's the time probably we'll see again a long, kind of a bullish market phase will begin in the Indian equities.
So the big driver of a strong bull market in the middle of 2023 is going to be interest rate cuts in India and globally?
Right. I think
what else will be the drive? Yeah.
Right. And if you see, last almost like 1.5 years, the market was subdued. In fact, equity returns were pretty much zero, almost like 1.5, 2 years. And, well, during the same period, earnings have grown substantially. So because of which valuations have corrected. That's one. And secondly, the interest rates coming down, and the growth, which was which will help the growth as well. So both the factors, valuations are corrected, and the interest rates coming down will lead to some sort of a re-rating of the PE multiple, and also will spur the growth. Apart from that, some of the measures that are taken by the the government as such in terms of the capital spending, if you see, these are the factors which I think will, overall drive the growth in Indian companies' earnings, and interest rate reduction will also lead to re-rating of the, stocks.
All right, got that. If we can ask you about some more of these individual sectors, what do you think of the pharma pack? Because, there has been around an 8% cut this year itself in the, overall in the index. Do you like anything from there? And if yes, what would you pick within pharma?
Right. In the pharma as such, if you see the Indian the domestic pharmaceutical market has been continuously doing well. Even the post-COVID also, the domestic pharmaceutical market continued to maintain a decent growth. So the domestic segment has never been much of a problem. The problem was largely the export market, mainly the US market, and there was a tremendous amount of pricing pressure for the last 3 to 4 years. I think the extent of the pricing pressure that has been there in the last 2, 3, 4 years is getting abated, and also the valuations are somewhat, I think, is reasonable. Because of that reason, we continue to like the pharma sector. Both the domestic market continues to do well, and the export market is now somewhat, I think, is bottoming out, I would say, in terms of pricing pressure. So because of that, I think pharma is a good overweight sector for us.
So, Sampath, just your thoughts. I know that you represent the sector, but if you can speak, more generally, without, of course, taking names, what is changing for insurers? Suddenly, there's some optimism coming in. The stocks, of course, have been beaten black and blue. Do you see this lasting, and beyond insurance as well, non-banking, non-insurance, anything else that you like in financials?
I think in the financial space, banking as such, we continue to like. And apart from that, if you see even asset management companies, they're also very good, high ROE companies, I would say. Their valuations have also corrected quite meaningfully. And some of the other infrastructure providers, whether it is RTAs or exchange is not, the major one is not listed, but even the credit rating agencies, they're all very high quality companies with, very good return on equity. I think, the whole host of other infrastructure players in the financial services, whether it is, brokerages, whether it is, AMCs, whether it is, credit rating agencies, we like them. We like them in terms of, the kind of business quality that these businesses represent.
Any sectors where you foresee a lot of decline still left?
I think, maybe, next 3 to 4 months, probably as a max, we could see slightly more headwinds. I think, interest rates are still, 1 or 2 more large rounds of hikes could still be there. That's how we think. And also, going forward, we are getting into the monsoon season. How the monsoons will pan out will also play an important role. I think, because of that reason, we are thinking that maybe the second half of this calendar year, or somewhere middle of this calendar year onwards, the opportunity to deploy a good amount of money for long term, will be there. And of course, even now also from a longer term investor, valuations have corrected. But I think a few more months of subduedness in the market is possible, given that it's already for 14, 15 months we are, markets have been somewhat range bound. We could see that this trend continuing for a couple of more months.
Your view is taken, right? The markets remain subdued, continue to consolidate for the next few months, and in the second half there is a pickup in the sentiment as well as in stock market levels. But any sector which you will avoid and not participate even in the second half, where you see the headwinds lasting beyond a couple of months, maybe for the next 12 to 18 months, any sectors which are headwinded?
Right. I think if you see the overall earnings growth in the market, our Nifty 50 earnings growth, around 12 to 14% is what is expected for next financial year. By and large, if you see, most of the growth is actually coming from the financial services sector, and followed by even auto is also coming out of a low base, is going to contribute to the good growth in earnings. So these are the two sectors we continue to like, and the FMCG and pharma and IT services companies, by and large, they will just grow within the industry level kind of growth in the range of about 10% kind of an earnings growth. They would neither be adding to the overall growth of the Nifty 50 large, depressing that. But the sectors probably which will cause a little bit of a the downward spiral, downward pressure to the Nifty 50 earnings growth looks like largely the commodities and also to some extent cement. I think these are the two sectors probably seeing a slight amount of degrowth or a low growth in earnings. Or probably apart from these two, I think the rest of the segment next sectors look quite good.
All right. Commodities and cement could see maybe a little bit more of a prolonged pressure in these names. Sampath, one final question. We were talking about valuations correcting. Do you think valuations have corrected enough in some of the new age companies for them to have your interest? Any of them?
I think that's interesting thing. New age companies have had a very high valuations level about 1.5 years back. If you recall, that is a time when the interest rates were very low and a lot of liquidity was available. When the broader economic situation is like that, the valuations for these new age businesses really got rich because for them the cash flows are going to come far into the future. The cash flows are not here to in the next 3 to 5 years or so. So when you see the DCF value of some of these kind of companies where the free cash flows are far ended, when the interest rate goes up and the liquidity becomes tight, gets tightened, the valuation compression will be much more severe. I think that's what we have seen in the last 1 year or so. I think we would still think that the new age companies will. Valuations are still rich given where the interest rates are, given where the liquidity situation is prevailing in the current global markets and as well as India. So liquidity will continue to recede and interest rate will, not come down so much sharply. Because of that backdrop, I think new age companies, I would still think that they may take a lot more time to recover rather than come to their previous highs.
All right. Still not looking at the new age companies. It may take a while. Sampath, thanks a lot for joining us and taking us through your call in the markets today. With that, we do need to get into a short break on the show. But on the other side, we're going to put the spotlight on a space that has really been buzzing this week, the entire insurance space. Stay tuned for our special segment, Clutter Breakers.
Welcome back. Well, as we've been pointing out, insurance is a sector that's seen plenty of buying over the last couple of sessions, especially today. And let's now move to our special series, Clutter Breakers. Insurance stocks, of course, has been in focus after the budget announcement of taxing high-ticket non-linked savings policies. So what is the outlook for insurance in the coming year? Surabhi Sutaria is here with more details.
Post the budget announcement of taxing high-ticket non-linked savings policies, all eyes are going to be on the premium growth numbers for the last quarter of FY23. The Feb business data shows divergent growth trends, where the private life insurance players saw an 18% growth in their retail APE, whereas LIC declined by 3%. Now, this growth should be seen in the context with the recent budget change and the fact that there are only a couple of months remaining now to escape the impact of taxation change. This is evident in their numbers as well. Most of this growth is led by high ticket size policies and not by the number of policies sold. The average ticket size is up 32%, whereas the number of policies sold is declined by 15%. In the listed space, all players, barring SBI Life, has seen an average ticket size growth of 15 to 20%, whereas the number of policies has declined by 2 to 21%. This growth is expected to continue in March as well, as the pre-booking of high-ticket non-linked savings products will continue till the end of the fiscal. Now, the analyst estimates suggest that the companies will see a growth of anywhere between 15 to 40%, as opposed to 5 to 10% same time last year. However, that number needs to be monitored is the number of policies sold. With all the negative sentiments around the budget announcement, there are a few amendments that can work in the favor of the sector as well. The possibility of a composite business license that will facilitate open access for the company to operate in any kind of businesses. And also, the regulator has proposed to simplify the existing regulations on commission expense and expense of management, which gives greater flexibility to the company to structure their commission payouts. However, the real question is, will these amendments outweigh the negative impact brought on from the budget announcement? Life insurance stocks have corrected anywhere between 11 to 23% since the budget day, and all of them are almost close to their 52-week lows. When you see their valuations on a one-year forward basis and compare it to their pre-budget levels, it has corrected quite a bit, with HDFC Life seeing the most correction, followed by SBI Life and Max Financials.
All right, Surbhi, thanks a lot for taking us through that entire roundup on the insurance space and what, the coming year could really look like. But with that, we do need to get into a short break on the show. When we come back, we're going to talk about the big global market cue that we're all watching. The U.S. Federal Reserve's rate decision is expected tonight. So we're going to bring you the expectations on the other side.
Welcome back. The big event today, and that's the Fed policy decision. It's expected tonight. And will the Fed hike, pause or pivot? And what about future rate hikes? Are those off the table now? Fed's commentary in the wake of contagion fears and the banking turmoil that we've seen will also be keenly watched. But now that some calm has been restored in the financial market, most respondents to a CNBC-TV18 Fed survey are saying that the central bank is likely to hike rates at the current meeting. CNBC's Steve Leisman gets us all the highlights of the survey.
This is an unusual meeting in extraordinary times, and it gives us a sort of unusual survey with a lot of uncertainty and disagreement about what will the Fed do and what should the Fed do. Take a look at our Fed expectations chart. 72% say there's going to be a hike, which is pretty much in line with how the market is priced. Interesting, because our survey was from the end of last week. But 52%, only 52% say the Fed should hike. So some percentage think the Fed ought to hold its powder right here. And the peak rate remains pretty high, actually higher than it was at 5.20 for June. But then 86% say the Fed either cuts or pauses at the next meeting in July. So, okay, here's the thing. We asked, what's the more important driver of Fed policy? Protecting financial stability and the health of the banking system or reducing inflation? 52% say it's financial stability rather than inflation. Here's some of the commentary we got. Joe Lavorgna from SMBC Nikko Securities writes, continued hawkishness from the Federal Reserve would justify a further marking down of our forecast for growth and recession severity. And then we have Mark Vittner of Piedmont Crescent Capital. He says the Fed's earlier missteps on inflation and its abrupt correction this past year laid the foundation for the crisis we face today. The Fed should not compound its earlier mistake by giving in too early in the inflation fight. What about the outlook for recession? 55%. It's up from the prior survey, 51. 57% say it's going to be a mild recession. And then interestingly, September 2023 is the average start date. That's a quarter later than the last survey. That's because we've had this strong growth in the first quarter, and the average length of the recession seems being 8 months.
All right, Steve, thanks a lot for getting us all of the highlights from the CNBC Fed survey. So 52% of the respondents right now saying that the Fed should go ahead and hike rates this time around. With that, let's also listen into some important opinion. This comes in from former Richmond Fed President Jeffrey Lacker. Listen in.
I think they should go ahead with a 25 basis point increase. I think they have still more work to do to fight inflation. And I think to pause now would send a signal of concern and worry and convey that they know that things are worse than people on the outside think. But I take Jay Powell seriously last December, and I think he was right then, that what happens at this meeting or any given meeting is less important than the destination of this journey.
Probably one of the most eagerly anticipated and probably would be one of the most eagerly watched Fed meetings in recent times.
High stakes.
All right, on that note, we'll take your leave on this edition of Trading Hour, but don't go anywhere. All the action continues. Halftime report up next.